This Week in Economics on the 24th of January 2016. Our presentation primarily revolves around the World Economic Forum, which is held in Davos, Switzerland. It is the place where the quote-unquote capitalist world are there, particularly the Western capitalist world. There is more inclusion now in what they term emerging markets. You'll hear from Christine Lagarde, Madame Lagarde of the IMF. She is on the panel. Martin Wolf, who writes a column in the Financial Times, been around a very, very long time. And it's interesting to look at this panel in terms of whom is on it and not on it, in terms of the various economies here and the representatives. From the UK, of course, you have him, that's George Osborne. You have Hakuto Romeo, the Bank of Japan. And, of course, let's see, who else do we have? The gentleman from the Credit Suisse, Tajini Tahame. And then from India you had Jetali. He is the representative from India. So India's there. China is not represented on this panel. You have Osborne, a leftover from the capitalist world of yesterday, known as the UK, the United Kingdom. Japan has been a player, but Japan has been in deflation for roughly 10 years. Many of these countries are using quantitative easing. So what we are hearing is basically a presentation, an observatory presentation on many of the world's issues. Example, there is not a representative here from Germany, which is the largest economy in the EU. The UK is involved in the EU, but not a member of the European Union. So a little bit different situation there. India, of course, is the emerging market. At the last portion, you'll hear the representative from India talk about the Internet of Things, IT, and how the government has now moved into that sector, putting funding there. And lastly, they touch on the 122 countries of Africa in terms of investment. Very, very short topic there. They also covered populist movements, particularly in the U.S., involving Donald J. Trump and Bernie Sanders. One is right and one is to the left of the political spectrum, at least in the U.S., a social democrat, Bernie Sanders. And Trump, more of a Peronist type populist to the right, anti-government, that's his supporters, and whereas Bernie Sanders supporters are dealing with economic equity and the banks and the entire economy. So a little bit different approach there with those the groupings. But one takeaway here, Christine Lagarde talked about data sets and how data is determined. They're moving to new formats. The the Chinese economy is in transition. They are moving from an exportive economy to a service economy based upon their 1.2 billion people and new opportunities out there. The Chinese president was in Tehran there, and more alliances, particularly across those 122 nations that compose generic term Africa and the Russian Republic and India. So there is a little different situation there, and the support by many here, Japanese representative, for the new organization, the Asian Industrial Bank, that's a Chinese backed bank, and the various machinations also with the old Western capitalists to shut China out. That cannot happen. The opportunities are in China as one of quote-unquote the emerging markets. They're in Brazil, but again, the commodities there, and that's what's brought up too. And one of the big problems here, you have the quote-unquote old ways of thinking, and that involves a lot of what Chairman Greenspan called irrational exuberance. The commodity markets that are very, very speculative. Speculative markets, in our opinion, are not good for the economy. They tend to create bubbles. And of course, quantitative easing, the idea was to get more liquidity in the economy, which happened. But it was misused in terms of creating asset bubbles, and that is one of the problems. Christine Lagarde addressed that, and as far as the banks, less of a problem because they have stress testing in the banking sector, whether it be in the U.S. or be in Japan, etc. So that alleviates some. But when I was at university, I remember we used to talk about another depression could not happen in the U.S. because of the safety nets, regulatory regime, and it did in fact happen. So those kinds of things, a very turbulent thing as far as communicating on China's part in a transparent manner. Part of the problem is the economies are not static, they're dynamic. And the best job of communicating many times cannot happen because there are contradictions. There's no, quote-unquote, as they like to say in the West, black and white in the study of macroeconomics. They are the ins and the outs of economy. Just looking to see here, we'll go to the markets very quickly because this is a short presentation. What we'll be doing here at the network is looking at the World Economic Forum from many different angles. On our political program, which is Bostonred, we'll be looking at it some, and this is, of course, primary time in the U.S. And on our other program, where we deal with the international sector, BR on the World it's called, we'll be looking at the World Economic Forum, and we'll go past the global part, which you saw today. So we'll be looking at those different sectors across our network, WBRN. Let's do the numbers very quickly here. The Global 30 from the BBC was at 92.97. The FTSE at 67.17. And in Amsterdam they were at 12.72. All of these, incidentally, in positive territory here. The DAC was 190.72. In Paris, they were at 130.29. In Brussels, they were, 96.10. In Madrid, 279.70. In Zurich, 236.06. In Moscow, these are all Friday, incidentally, 40.79. In Johannesburg, they were actually in negative on Friday, minus 294.82. In Bombay, also on Friday, 373.62. In Karachi, 197.22. In Lahore, they were in negative, minus 45.11. In Colombo, 32.63. In Tehran on Wednesday, 444.40. Very good day for them. In Sydney, 52. The Nikkei was at 941.27. The Hang Seng 538.36. In Shanghai 36.08. In New York they were at 210.83. The Nasdaq at 119.12. The Merck commodities market out in Chicago 37.91. In San Pablo 314.11. And finally in Mexico 454.43. And let's quickly look at the commodities. Brent crude primarily is our focus here. It was up $2.86. The spot was up $2.52. It was rested at $32.10, and the spot at $31.45. West Texas Intermediate was up $2.63. It has become now a competitor to Brent crude. The whole idea now of the relaxation of the export prohibition in the U.S., that crude can be exported at $32.16. T-Boone Pickens is jumping for joy. That's a change of 8.9%. Cocoa was up $17. Gold was, let's see, on the Forex, up 85 cents at $1,097.65. The Eurex futures, cocoa up $2. We just give a few of these. Robusta coffee was down $9. The Bloomberg index at 76.24, and that was a 1 plus, as they call it, 1.44. And that'll do it for us on this report. For those in business, make it a productive next week. For the consumer, obviously keep your eye on the prize, not any particular order. And we'll talk to you soon. Good day.
Lagarde, the managing director of the IMF, and it appears very likely to continue to be the managing director of the IMF for several more years, partly because of the enthusiasm of people like her neighbour to her left, George Osborne, the Chancellor of the Exchequer of the United Kingdom, who of course has nominated her for another term. To his left is Arun Jaitley, Finance Minister of India, certainly the fastest growing large economy in the world. To his left is Haruhiko Kuroda, Governor of the Bank of Japan, and a man engaged in one of the most important and interesting monetary experiments of all time. And finally, to his left, it's Tidjane Thiam, who's Chief Executive Officer of Credit Suisse AG. So just to introduce it, our discussion where we are now, as you have all surely noticed, in the last month we've had an immense amount of market turbulence in exchange markets and in stock markets. The S&P is down to 1900, but as I recently pointed out, on many measures still pretty highly valued. Oil is, I just looked up in my paper this morning, West Texas International is at 31.60, still incredibly low. That's a very significant price adjustment. Worth remembering, however, that we are also in an environment still of unbelievably low bond yields. US 10 years at 2.06, German 10 years at 0.49, and the Japanese 10 year at 0.24, which is really staggering. The IMF, looking at the economy, has produced its recent forecast, and it's perhaps worth mentioning in view of all this turbulence, and I'm sure Christine Lagarde will say more about this, that they expect this year's growth to be higher than last year, at 3.4% against 3.1%. If we look at the big issues in the world economy, there's the immense adjustment in commodity prices, which is very, very damaging for quite a number of companies and, of course, countries. Brazil and Russia are notable big victims, but it's important to stress there are very important gainers. China, India represented here are big gainers, and so, of course, is most of Europe. But it, of course, creates huge challenges. Another economic issue of some importance it does appear very recently that the US is slowing at the same time as the Fed has decided to tighten rates. There's a big concern about a number of financial risks, corporate debt in emerging markets, and of course, debt overhangs in developed market economies remain very large in many countries, private and, of course, public. It's perhaps worth stressing that we do solve some problems. This year, nobody is obsessed with the possibility, rightly I believe, that the Eurozone is about to fall apart, and not much discussion of Brexit. Instead, we now talk about Brexit. So we will have that discussion instead. And Brexit is just one of a number of examples of major political risks or politically driven risks which have economic consequences. The migration crisis, quote unquote, in Europe, the fascinating, and to some people, certainly including me, terrifying possibilities in the US presidential election, the rise of populism everywhere, and international relations issues in the Middle East between Russia and Europe remain very, very significant. So these are very turbulent and fascinating times. So in view of this, I've decided we're going to start with a view of what is going on in the markets and how significant it is for the economy, how worried we should be. So I'm going to start with Tidjane Thiam and ask him for his brief reactions on what on earth is going on from the perspective of someone who's actually having to manage it and survive it day by day.
Yeah, thank you, Martin. What on earth is going on? Simply the worst start of any year on the record in financial markets ever. Simple. So if you look at the numbers, it's the worst start we've had 3 weeks in the year ever. So what's driving that? Maybe I can say a few words about what I think the market believes and then say what we believe. The market is very worried about China, of course. Growth in China, we've seen the 6.9 coming out, the two issues there. The market doesn't necessarily believe the 6.9 and also believes that there may be a hard landing in China or a very significant decrease in growth. And that has direct implications on through commodities and oil on growth in other parts of the world. So the fear that we're walking into a global recession and also a lot of fears around the oil sector itself, which for the shale gas operators is highly leveraged. And we've seen the high-yield debt repriced very brutally at the beginning of the year, at the end of 15 also, triggering losses in portfolios. And you will have, in the background of that, that's really important, also a technical factor, which is massive redemptions, massive outflows from asset managers, some of them driven by sovereign wealth funds, liquidating positions to generate cash. So you have a lot of distressed sales in the market, which is also weighing on market level. Now, quickly, what we believe. We actually believe that China, will have a soft landing. We are not concerned fundamentally about Chinese growth, and I'm sure we'll come back to that. I'm sure Kuroda-san can comment on that more precisely. And the oil argument is all about, is this a demand issue or a supply issue? And a lot of people in the market believe that demand in China is decreasing, and that's really announcing a slowdown, a more pronounced slowdown of growth in China. We actually don't agree. There is very good evidence that the net demand for oil has increased in 15, something like 1.2 million barrels per day, and we think that half of that is China. So actually the demand for China has increased. So it's a supply problem, not a demand problem, which is good news for the world economy. And we also believe that the low oil prices are good for the world economy, good for the US consumer, good for Europe, and good for over 5 billion people on the planet who are basically net importers or net consumers of oil. It's increased consumer purchasing power, and that's good for growth. But that's a short answer.
So just to summarize very briefly, your view in a way is that the markets have been overshooting rather significantly, and we shouldn't get too hysterical about it.
I would say overreacting, and this is compounded by the structural decrease in liquidity, which we have observed in the markets. We know that the ticket size in many markets is lower because we banks as market makers adapting to a new regulatory environment basically reduce our inventories and our ability to make markets. So for all other things being equal, the same news flow will trigger a bigger reaction in a low liquidity environment.
Well, thank you very much for that very clear statement of where you think we are. So, Christine Lagarde, in that light of that, how do you see the global economic outlook over the next year, and how do you react to the judgments here of the major driving forces?
Thank you, Martin, and good morning to everyone. We see global growth in 2016 as being modest, uneven, and with 4 downside risks. But it's up. I mean, we tend to forget that, as you said, Martin, from 3.1 in 2015, we see that 3.4 in 2016 and 3.6 in 2017. So there are factors that will actually increase the global value of our economies. Now, let me focus on the 4 risks that we see on the horizon. One is what I call the triple transition of the Chinese economy. And by triple transition, I mean moving from industry to service, from export to domestic market, and from, I always tend to forget the third one, so industry to service, export to domestic, and investment to consumption. Yeah. That's the triple transition that it's going through. It's a massive undertaking, and it's one where we forecasted China to be at 6.8 in 2015, they're at 6.9. So for those who pretend that they're very, very surprised about it, well, certainly it was expected. And we hope that the Chinese authorities will recognize the efforts that it takes to conduct those 3 transitions that they are determined to conduct, and that it will have an impact on the growth rate, and it will slow it down, which would be a good way to actually facilitate the transition and lower that first downside risk. The second downside risk is commodity prices, which have trended lower for the last 5 years, but where the lowering of prices have been accelerated, and certainly the perception of it has been accelerated in the last year and a half as a result of the oil prices, which is probably slightly going to improve as demand seems to improve a bit over the course of the last few months. To be seen, but still regarded as a downside risk. The third one is the asynchronous monetary policies conducted around the world, which entail quite a lot of flow of capitals from emerging and low-income countries to advanced economies, particularly the United States, and which entail, combined with the lower commodity prices, a significant exchange rate impact by way of depreciation on some of the emerging market economies. Just a quick word on those emerging market economies, if I may, Martin. Mm-hmm. They are different. We used to talk of the BRICS. I think it's not a fallacy, but the economic performance is vastly different. Whether you look at India, which is cruising at 7.5% and seems to be thriving, which is conducting some difficult reforms. China, which is gradually slowing down in hopefully a controlled way, with financial markets, by the way, which are extremely minute relative to the size of the overall Chinese economy. Russia and Brazil, which for different reasons are going to be in negative territory yet again this year. So complete different picture from the emerging market economies, which, I remind you, were the big drivers of growth and had been for the last 5 years or so. So the picture is changing, but, you know, to be positive, the things that we feared a year ago would never happen, which have happened. Financing for development was agreed in Addis Ababa about 6 months ago. The Sustainable Development Goals were agreed in New York, which will entail significant change in the economies and hopefully in the policy decision-making, particularly in the low-income and emerging market economies, and COP21, which will also entail changes in our economies.
So, modest optimism, but significant risks. Yep. It's interesting, you didn't emphasize at all what you think might be happening in Europe. Are you reasonably confident about the upswing there? Eurozone problems all resolved, as it were, Greek problem all resolved, and we can just put that to one side?
Well, I felt that I was talking too much from your body language, so I stopped on Europe.
No.
But,
always more. Happy to have more.
Okay.
Within reason.
On Europe, the economy is certainly in a better shape. Our forecast for the Eurozone is 1.5, slightly lower than the Euro players themselves. We have two big concerns. One is better discussed, I think, by George, and that has to do with Brexit. And whether there is a deal to be had between the United Kingdom and other members of the European Union, which we hope very much, because it would really be conducive to more stability and a more cohesive economic zone. And the second is of a geopolitical nature. It's not directly economic, but it's economically related somehow. It's the refugee crisis, which is a bit of a make or break from my personal perspective, not the perspective of the IMF. Because our IMF perspective on the refugee crisis is that if it is well handled, if the integration process is conducted in a cohesive and organized way, in the short, medium term, it's going to be an upside. And we figured that for the Eurozone, on average, it would be a plus 0.2% growth with uptick of up to 0.5% for countries like Germany or Sweden, which are the most likely to integrate refugees.
Do you actually think, can't resist it, that this is obviously your personal view, but you've raised it, that the refugee crisis, because we had a very similar view from Mark Rutte here just a few days ago, is sort of make or break for the survival of the whole Schengen area?
You know, again, I speak personally, not as MD of the IMF, but yes, I think so.
So, George Osborne, if I might turn to you, how do you view Britain in the context of Europe and Europe against this background? And could you talk a little bit more about this Brexit risk, which is certainly concerning people here very much? So when we meet here a year from now, what are the chances that Britain will actually be in some sort of limbo and nobody knows where it's going to go?
Well, I mean, Britain has been one of the bright spots in quite a gloomy global economic situation, and the IMF have us as one of the fastest growing of the advanced economies. Just had unemployment numbers a couple of days ago that show a record labour participation, the highest employment rate in our history, and low unemployment. And our sustained effort to reduce the deficit has brought it down to close to a third of the 11% deficit that I inherited in the job. So, you know, I think by following a clear economic plan, by taking some pretty difficult supply-side decisions, by reducing government budgets, we've given the UK a pretty secure footing going forward. But we're not people who have tried to duck the big issues facing our country's future. You know, we put to the ballot the future of the United Kingdom, and as a result, I think, checked a move towards the breakup of our country. And as a result, and I'm very grateful for this and was pleased with the results, Scotland is part of the UK. Now we've got another challenge, which is our membership of the European Union. Britain is the second largest economy in the EU. We're the second largest contributor to the EU budget. On many forecasts, by the 2030s, we'll be the largest economy in the European Union. But we are not in the Eurozone and we're not in the Schengen area. And so Britain has, in that sense, a different relationship with the European Union to other member states. And what we're seeking, I think, are improvements for all of Europe, not just for the UK. We're seeking a much more competitive European Union. I mean, I have sat on panels like this for the last 5 years where people have talked about free trade deals and completing the single market and so on. We need to put that into action. We need to, as the Chinese proverb goes, talk does not cook rice.
The inflation target.
But you're not saying that right at the moment that you feel it's necessary?
We have been carefully watching the market development as well as the real economic development in Japan and also in Asia. As I said in my at the outset, the financial market turmoil this month has been somewhat more than anticipated. And so we have been and we will continue to carefully monitor those market developments and also continue to assess the potential impact of those market development on the real economy, including growth rate and unemployment rate as well as inflation rate.
Now, one of the issues in the monetary sphere, which I think Christine Lagarde mentioned, I'm pretty sure, is monetary policy divergence. So we've got a situation, you're easing, the ECB seems pretty clearly is easing, Mark Carney's recent speech suggests the Bank of England is neutral and the Fed is tightening. And into this mix is a very uncertain situation. We have, even the Chinese officials admit, very badly communicated about Chinese monetary policy and Chinese exchange rates. This seems to be part of what markets are worrying about. Does this combination of events worry you, or is it just a perfectly reasonable consequence of divergent situations among major economies?
Quick answer is, I think the divergence of monetary policies among major economies, I think is just reflecting divergent economic and financial situations in those economies. As you mentioned, Federal Reserve has already started normalization of monetary conditions, while the ECB and the Bank of Japan are likely to maintain extremely accommodative monetary stance for some time to come. These, I think, are quite natural and reasonable. By the way, this asynchronized kind of monetary policy among major economies could mitigate the impact of normalization of monetary policies by those central banks. Because if not only Federal Reserve, but also Bank of England, the ECB, as well as the Bank of Japan, all of them started to exit from the current expansion in monetary policy at the same time, in a synchronized way, the impact on the global financial situation, particularly on emerging economies and developing countries, could be worse than the current staggered or asynchronized sort of monetary policy making. Second question is a bit different. Chinese monetary policy, I think, has been quite appropriate, being accommodative because inflation rate has been fairly low and the economy is still growing but slightly decelerating, and so accommodative monetary stance is quite correct in China. The issue is exchange rate and monetary conditions. And I think the Chinese authorities have been struggling in some sense to avoid, on the one hand, excessive depreciation or appreciation of its currency, but on the other hand, they have to maintain accommodative monetary stance. So this is my personal view, may not be shared by the Chinese authorities, but in this kind of somewhat contradictory situation, capital control could be useful to manage exchange rate as well as domestic monetary policy in a consistent and appropriate way.
That's actually a question I wanted to ask Christine Lagarde, so you got there. So the Chinese authorities are losing reserves at a very remarkably rapid rate. there's a large capital outflow. They've moved to a new exchange rate system, and you've just put them in the SDR. How would you feel about if they said, well, the only alternative to letting the exchange rate go, adjust downwards, is to use up all our reserves we don't want to do, and the other alternative, that's one alternative. The other alternative is capital controls on tighter capital flows on the outflows on a temporary basis. How would the IMF react to these alternatives?
Well, I think that the massive use of reserves would not be a particularly good idea.
Can't do it forever.
No,
anyway.
that's right. Absolutely right. Absolutely right. And some of it was used, which leads me to another point, which is I believe that now that the quota and governance reform of the IMF has been ratified by the US, the size of the IMF is bigger, which I think is the beginning of a trend that should continue. The IMF should continue to be large in order to be seen as an international safety net that can be used and that can protect against such shocks.
So
but that's an aside.
Objective for the next term.
That's an objective for the IMF. You're absolutely right.
Okay.
And on the other issue, I think that some of the macroprudential measures that have been adopted in the last couple of weeks were justified and are probably useful in the context of the current monetary policy questions that the authorities have to ask themselves. That's point number one. Point number two, and I've gone public to say that 3 days ago, you said they have changed the exchange rate mechanism, and yes, they have. But I think that what is necessary for markets is clarity, certainty, one message, and on that front, clarifying precisely how the exchange rate mechanism works and against which basket of currencies as opposed to the dollar, which is always the reference that is still made as far as the variation of the renminbi, would be a right move in the direction of setting expectations so that everybody knows that actually the pegging system that the Chinese authorities have used for the last 12 months or so has actually been the pegging against that basket of currency and ineffective.
So whatever the policy might be, it really would help if we knew what it was.
Yes, clarity of message.
Okay. I think actually that seems to be shared. Perhaps in emerging economies, because so much capital flowed into them in response, so much money flowed into them, and now it's being pulled back. So the sort of monetary authorities are actually creating financial risk. And the other concern is indeed what I just talked about with Mr. Kuroda, that the divergence between authorities is also creating great financial stresses. How far would you share this both as either an observation or as a criticism of what the monetary authorities have been doing since the crisis began?
Yes, thank you, Martin. I mean that. The world has changed a lot since 2008, and banks have changed a lot. If you throw yourself back then, we had huge balance sheets, we were highly leveraged, and after a long period of asset price growth, there was a kind of excessive animal spirit, if I can describe it that way, and excessive risk-taking. If you look at where we are today, and that's the good news. I want to start with the good news, really. I think, and I was teasing Mark Carney this morning, and I said I complimented him live on television, but I did. So for a bank CEO, that's a bit unusual. But I think that... Sorry? Unprecedented. Well, there you go. It's been done now. But I think the FSB actually has done a very good job in terms of... in a way, forcing us to strengthen our capital base. Because the one thing I haven't said in my introductory statement when you asked me about markets, there is absolutely no worry, no contagion risk about banks. Right? That has not come up in the debate. And that's a huge tick for the regulatory system, the central banking system. Some of the numbers are really staggering. If you look at the total loss of absorbing capital that we're being asked to raise, I think the figure at the end of 19, ex-China, will be $4 trillion. So we collectively, the banks, will be holding $4 trillion of capital. That means that we can go through a stress event, we can go through a UBS, and this is not a dig at the competition, it's just a reminder of the past. We can go through a UBS, a Citi, and a Merrill, assuming we cannot raise capital and markets are closed, and we could continue to operate and fund the economy. So that's a big achievement, I think, for the economy, and we should take that. Now, on the less positive side, yes, you have to deal with the divergence that Christine referred to, the asynchronicity of monetary policies across the big monetary zones. But I'm with Kuroda-san on that. I think it's a bit unavoidable. QE was an effective answer. I'm not saying the right, but certainly an effective answer to a major financial shock. And the exit of that is, I mean, there's already many articles written about it. The exit of that is quite a delicate phenomenon. And frankly, it cannot come too early. So personally, personal view, I think that the normalization is necessary because I don't like periods where the price of risk is distorted for a long period of time. Because based on that, if you wish, distorted price of risk or risk-free rate, people take positions, make decisions to invest or not to invest, etc. You risk developing asset bubbles in various places, and really the exit of all that is delicate. But that's why I started the capital. I said trauma a few months ago, or commotion at the exit. The system can withstand it, and that's the fundamental message, so that we can come out of this period and then look to a normalized environment with more serenity.
It's an important country like India.
Indeed, it would be. And it would be for several reasons. One of the reasons you've mentioned that Indians over the last 2.5 decades took naturally to IT. This was one sector which in India never got regulated, and fortunately, because of that, a lot of energies have been unleashed both within the country and outside. We saw the impact of this.
The government didn't notice it existed.
And recently, I think the startups in India and the new policy of the government also is intended to encourage that, giving them tax break, organizing funding from that for them. And at the same time, the government maintains a distance, a no interference policy. A large amount of relaxation from normal laws, etc., have been given. And we can actually see literally hundreds and thousands of them experimenting all over the country for innovations, coming out with easier solutions. And I think in years to come, this is going to be a very powerful segment of Indian economy.
Who would like to respond on this question of the technology fund, and particularly in relationship to Africa? Would you like to talk about that, or yeah. George Osborne? We have a very large aid program. We are very interested in our role in development. I know, but so what is your perception on what can the developed countries do? And I think there's actually a very particular issue which might be touched upon in this, since we've just had COP21, this whole climate change technologies, not just IT sort of thing, the role that the developed and other countries and private institutions can play in getting these technologies into the developing world.
Well, I mean, the United Kingdom is one of the few countries and the only large country that contributes 0.7% of its national income on international development. That's a decision we've taken even in a period of very tight public budgets. It was a challenge bringing the British public with us, but a combination of the Ebola crisis in West Africa and the migration crisis across North Africa and the Middle East, I think actually is starting to make people aware in my country that if you try and tackle some of these problems at source, if you develop these economies, then people don't feel they need to move for economic opportunity, and you have longer life expectancy and rising living standards. Africa is an enormous economic opportunity, one of the, I would say, bright spots in the world economy, and investment there in infrastructure and technology and the like, I think pays huge dividends, not huge dividends, not just economic returns, but massive political returns.
Does anyone? Yes, please, of course.
Just very, very quickly, particularly given the fact that the young leader from Senegal has raised the issue of women and girls. You're right, Martin. COP21 was a big boost, but in countries like Senegal and very many other African countries, actually, it starts with power. And there are multiple ways now and improved ways to obtain power, but it starts with power in Africa. And it takes me back to another point which has to do with stimulating demand, which everybody is crying for. Investing in infrastructure is actually a critical step towards setting more power sources in African countries. On the funds for girls
you mean
and...
power as in electricity?
Yes. Oh, yeah.
Yes.
Yeah, I'm sorry.
Be clear.
Energy sources, such as power. And on specific funds for girls and women, they exist. I don't want to mention any name because they're generally privately owned and driven and governed. But I've heard a lot about the IoT, IOV, which is Internet of Things, Internet of Values. I would hope that there is an IOW, Internet of Women, which can actually help with moving women in the direction of those funds that exist.
Tijan.
Yes, mostly I wanted to salute you because I was a global leader for tomorrow, class of 97, so from one to another. Hello.
So in a few years, you will be up here on the platform.
You're elder. And also just reinforce Christine's point that there are funds that exist. I won't mention name either, but there are funds that exist. Absolutely back her on infrastructure, and I led the G20 panel on infrastructure. She was very supportive. Absolutely vital for those countries. And make a final point, something I very much care about, which is the mobilization of domestic savings. The big hole in the strategies of development in the emerging countries is, and that's where maybe I'll differ with the young lady, I don't think the answer should come from London. Okay? There is capital in Africa. It's an aberration that we don't have pension funds. Young countries should have pension funds. When you have a positive demography, it's the right time to put in place pension funds, and those should provide patient, long-term capital in local currency that can do all of those things.
And Mr. Kuroda, but comment incredibly briefly on this,
Yep.
and then perhaps respond to the question, why haven't we changed our monetary and fiscal frameworks when we think everything else should change?
I have intended to respond to the question related to policy framework.
Yes.
As
Very
you may
good.
know, 2013, the government and the Bank of Japan agreed to a package of policies or policy framework under which monetary policy would pursue
The fourth industrial revolution is that there are lots of things that we don't measure well, and I think we have to go back to GDP, calculation of productivity, value of things, in order to actually assess and probably change the way we actually look at the economy, and we will be working on that. On China, I've heard for the last 10 years that we are just about to see a hard landing. Everybody here on this panel tells you that we're not seeing a hard landing. We're seeing an evolution, a big transition, which is going to be bumpy, which will offer some turbulences. We have to get used to it, and it's a very normal and proper way to actually move towards a more sustainable and more quality growth, we all hope.
George Osborne.
On China, I mean, China's been a big theme of this whole week at Davos, and I would say this, in my lifetime, the biggest single instrument for ending poverty and making poverty history has been the growth of the Chinese and Indian economies. Even China growing at this rate is going to add an economy the size of Germany to the world's economy by the end of this decade. And I think, if I can end on a geopolitical point, the world has not been very good over previous centuries at accommodating rising powers, and it's often led to unhappy outcomes. I think it is massively in our interests that we bring China into the multilateral institutions of the world. We reform the IMF, as Christine has done. We bring their currency into the global markets. We support the Asia Infrastructure Investment Bank and the like. It is hugely in our interest that China feels part of the global system and that system works for them. So we must be in it for the long haul as this